IndiGo, Aviation and SpiceJet have had a hard landing on the bourses so far this calendar year. Shares of IndiGo Airlines have tumbled 10% on a year-to-date basis, while those of SpiceJet have crashed 30%. In comparison, the benchmark S&P BSE Sensex has slipped 5% and the BSE Mid-Cap Index 7.4% and the Small Cap Index 10% during the period. However, analysts don't see clear skies for the two players going forward. Rising crude oil prices and entry of Akasa Air and Jet Airways cast a spell on their prospects.
See, we believe with new entrant, the competition is going to intensify in the airline sector as the new players would definitely try to make their mark in the fast-growing aviation sector. And if we talk about the demand scenario, it has improved significantly. It's almost 70% of the pre-COVID level. So the long-term growth story definitely remains intact, but with the new players now, there is a possibility of price war, and it will be more on the price correction instead of rising the fares. And this situation wherein we are seeing crude hovering around $120 per barrel. So it's not an ideal situation for the airline sectors to go for such kind of competition, so as that would impact their margins.
Brent crude is testing $123 per barrel mark in the international markets after staying range-bound within $105 to $110 per barrel for the better part of May. According to analysts, airlines have historically revised airfares based on the supply situation. Thus, an upward revision in fares, if any, may be some time away. But there are caveats.
So yeah, they're not going to absorb the cost because the last parking aircraft and storing aircraft over the last 2 years throughout the lockdown, that cost has been quite severe, and airlines haven't really recovered that cost. So they're not going to absorb this at all. I mean, they'll pass it on to the traveler, and the traveler will have to pay for it. The cost of fuel is going to rise up. The cost of insurance is going up. In fact, flying to Europe is going to be more expensive because you'll be flying over a conflict zone, right? And because you're flying over a conflict zone, you'll end up paying something called WRI, or War Risk Insurance. So the cost impact is going to be quite significant. It's going to be significant. That'll raise airline passenger tickets by at least 25%.
Meanwhile, Rakesh Jhunjhunwala-backed Akasa Air is mulling the launch of its commercial operations by July. Jet Airways Air Operator Certificate 2 was revalidated by the Aviation Regulator Directorate General of Civil Aviation in May. With these developments playing out, Ansuman Deb of ICICI Securities believes the road ahead for incumbents will be to keep maximizing yields and try keeping costs low. Some of the cost savings, including cut in salaries, will reverse now, which will push up expenses further. However, route-specific innovations will be critical from here on. Against this backdrop, here's what lies ahead for investors.
Airlines historically have proven that they are not long-term investor stocks which have created wealth, but favorite for traders. Looking at the current situation, there is a sentimental bias towards airlines, where the post-COVID opening up story has played out extremely well, as both business and leisure travel have boomed. However, crude, I think, has played a spoilsport, though the fares are higher and capacity utilization has improved considerably. The margins are still faltering. Now, with two more players in the fray, Akasa starting possibly in July and Jet Airways maybe 2-3 months later, competition is clearly hotting up, especially when the peak season is getting over. And it would be a great time for customers, as discounts will be high and so many more seats in the market. And unless crude really corrects sharply, airlines will still struggle to remain in the green. So I think it's a good time for flyers, but surely not for investors.
Surely airlines are in the soup as soaring fuel costs bite into their profits, while increasing competition dents prospects of fare hikes. The near-term outlook, therefore, remains under pressure. Meanwhile, Thursday's trading session could be marked by volatility as investors will adjust their positions ahead of the weekly F&O expiry. That apart, stock-specific action and global cues will dictate the market trend.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.